Great. So today is we're going to go over a solo 401k webinar, and really, a solo 401k is a very powerful tool. And so the point of today's session is really educational. We're not going to be giving any type of legal advice or tax advice. And so we're going to really talk about it at a high level in terms of who's eligible to set up a solo 401k, and really start to learn about some of the powerful benefits of it in terms of what you can do with the solo 401k. So to go into the first introductory slide here, these are the questions that we're going to be going through. What is a solo 401k? Am I eligible to set up a solo 401k? Can I roll over my retirement funds to my solo 401k? Who holds my solo 401k funds? Can I invest my solo 401k in real estate? Can I borrow from my solo 401k? And finally, how much can I contribute to my solo 401k? So to get started here, we're going to talk about what is a solo 401k. A solo 401k is really just a traditional 401k. If you look at the IRS guidance and language, they talk about how it's really just a traditional 401k, but it's a special subset or kind of 401k, which is referred to as a one participant plan. That's the technical terminology in the rules. And really it's designed for self-employed individuals, because in order to have a 401k, you need to have a business. And so even though it might be a one-person business, the rules allow that business to set up a solo 401k. And so it's called a one-participant 401k. And again, it's not a new type of 401k plan. It's got all of the same features of a 401k, but actually less compliance requirements. And the reason for that is a lot of the compliance requirements that apply 401k plans are there to protect your common law employees. But the reason for those requirements really goes away if you've got really just a one-person business or a husband and a wife business, because the business is not going to discriminate against themselves, of course. So a lot of the compliance requirements go away, and so it's much more streamlined. It's much more cost-effective than a full-fledged multi-employee 401k. And so as you're reading about and researching solo 401ks, you might come across different terminology. And I've got it listed here on this slide. It's sometimes referred to as an individual 401k, single K, uni K, self-directed 401k. And all those are really marketing terms and referring to what, again, is called a one-participant 401k plan. Now, before we go on to the next slide, I do want to touch on some of the exceptions to that one participant rule. One exception is for spouses. So if you have a husband and wife that say got a realtor business, right? Even though there's that quote one participant requirement, there's an exception for spouses. There's also exception for other owners of the business. So if you have two owners of an LLC, and it's a consulting firm, they're going to be eligible. Again, as long as the business doesn't have any full-time W-2 employees. So that's the other feature in terms of eligibility. The business cannot have any full-time W-2 employees. And so in terms of what it means to be full-time, that's really going to be defined as working 1,000 hours or more. And this is going to bleed right into our next slide, which is, eligibility. So in order to be eligible, it needs to be a business with no full-time W-2 employees. In terms of the business itself, it's got to be a quote active business. If you look at IRS publication 560, which is really the landmark guidance in terms of, I'm sorry, we're getting some feedback. I'm going to go ahead and mute everyone. Great. I believe everyone can still hear me. But going ahead with the presentation, it needs to be a quote active business. So if you look again at the IRS guidance, which is the landmark guidance is found in IRS publication 560, they talk about what it means to be self-employed. And really it comes down to making money off of your personal effort. And so some common examples, of course, would be, like I mentioned, alluded to before, you've got a realtor, perhaps a consultant, a solo practitioner attorney is going to be eligible. Any type of professional services, of course, are going to be eligible. Even an Uber driver, right? Because that person is getting paid on a 1099 basis. So an independent contractor, somebody that might be, working for a big corporation, but they're getting paid on a 1099 basis. Those are all good examples of people who are eligible to set up a solo 401k because they're making money from their personal effort. Now, a common question that comes up is, do I have to have a business? Do I have to have an LLC? Do I have to have an S corporation? And the answer is no. How you organize your business is not going to impact whether or not you're eligible. Now, later on, keep that in mind. We're going to talk about contributions, and that does impact how the contribution limits are determined. But in terms of eligibility, your self-employed business could be organized as a sole proprietorship. It could be organized as an LLC. It could be organized as an S corporation. What's really important is the nature of the business. You've got to be making money from your personal effort. Sticking on that topic just a little bit, a lot of people will ask whether or not they might be making money off of real estate, say real estate investments. They might have a W-2 day job, so working for a large corporation. That individual is not going to be self-employed based off of that activity, but they might have a side LLC that has a rental property. It's just they're earning passive income. That's an example that would typically not qualify because the income from that real estate investment is passive. Oftentimes it's going to flow on the Schedule C on their taxes, which is going to be passive income. They're not going to be paying any type of self-employment tax on that income. So they're not going to be able to take the position that an LLC where they're earning passive income is somehow a self-employed business for purposes of setting up a solo 401k. And if you go back to that key concept, that basic concept of making money from your personal effort, if you're simply invested in real estate, you're really making money off of money that you already had, right? And so it's passive income. You're not paying self-employment tax. That's not going to be eligible. Now, another common question that will come up is someone will ask, they'll present a scenario where they have a W-2 job, but they're also might have a side business, not the real estate context, but instead they could be, for example, an IT professional that might have some type of website hosting business or perhaps a web design business that they work on during nights and weekends. And that individual, even though they have a W-2 day job, that's not going to impact their eligibility because they're able to use their side business, again, assuming they're making money off their personal effort and there's no W-2 employees to set up a solo 401k. Again, that's another one. We'll keep that in mind when we go on to discuss contributions because that can impact their ability to contribute. So just to finish up with some other important concepts in terms of eligibility, we did talk about spouses and partners and how they may participate. Those are exceptions to that one participant requirement. Another important factor is control groups. So when determining eligibility, it's important to look at all the businesses that are owned. You might have a serial entrepreneur that could have a consulting business and might also be invested in have another business that has W-2 employees. If that person owns both businesses 100%, then those two businesses are going to constitute what's called a control group. And for purposes of determining 401k eligibility and who needs to be offered the 401k plan, the control group rules will tell us that the employees of either of those businesses are going to be considered employees for purposes of the plan. So if that person, even though they have a one-person shop that's a consultancy business, the fact that they have another business with W-2 employees is going to preclude that individual, and they would not be eligible to set up a solo 401k. Okay, so let's move on then off of the eligibility topic and go on to our next question that we covered at the beginning of the presentation. Can I roll over my retirement funds in a solo 401k? And the answer is generally yes. Most type of retirement accounts are going to be eligible. You could have often a scenario is going to be somebody who's self-employed. They may not have a 401k because they never worked at a big company, right? So this could be their first 401k. They may have been saving money in a SEP IRA or a traditional IRA. They may have had a previous job and rolled over money into a rollover IRA. So all of those accounts are eligible accounts. As long as they can liquidate that investment, they're going to be able to transfer it over to the solo 401k. A simple IRA is also going to be an eligible type of account, provided they satisfy the two-year requirement. So they're going to have that for 2 years before they're going to be able to transfer it over. A former employer retirement plan. So once they've left their job and if their money is still with their previous employer-sponsored plan, such as a 401k or a pension, a thrift savings plan, all of these, again, are going to be eligible types of plans. And they're all going to be moved over as what are called trustee-to-trustee transfers or direct rollovers, depending on whether it's coming from an IRA or an employer plan. And whenever you transfer money via a trustee-to-trustee transfer or a direct rollover, that is going to be a reportable event. So the previous custodian or administrator of that account is going to report that transfer. It's not a taxable transfer because it's going directly to another qualified plan. As long as it's going to a qualified plan, such as a qualified solo 401k plan, then that's not going to be a taxable event, but it will be reportable. The prior administrator or custodian would issue a 1099-R in the following January to report that to the IRS. And they would be issuing that with a code G in box 7. So that indicates to the IRS that this is not a taxable transfer. So that's going to be important. So in the whole transfer process, that's where you really want to work with people who have experience and expertise in guiding that transfer process, because otherwise you could set yourself up for some pain and suffering, because if it gets reported as a taxable transfer, then you would likely get a letter from the IRS when they don't see that income reported on the individual's taxes. They're going to be looking for it. So we commonly see those if the administrator, it's uncommon with our clients because we lead the transfer process, but on occasion you will see an administrator that it makes a mistake. And so, typically they can be resolved, but it's not something that you obviously want to set yourself up for. So sticking on the transfer and rollover topic, another type of transfer would be an indirect rollover. And that's come up, actually there's been some activity in this area in terms of indirect rollovers. An example of an indirect rollover would be where someone takes money out of their IRA, for example, and then they have, quote, 60 days. They have 60 days to put it back into another IRA or a qualified plan, so to avoid paying the taxes and penalties that would apply if it was a distribution. So those have recently been restricted such that now one is only able to do one indirect rollover, regardless of the number of, say, IRA accounts that the individual has in a 12-month period. So that's definitely not an ideal way to transfer the money, because number one, if you've done an indirect rollover in the past 12 months, then it's going to be considered to be a taxable distribution if you take the money out where it comes directly to you as opposed to going to the new plan. Number two, now you've used up your indirect rollover, and if there is ever a need where you to take an indirect rollover in the next 12 months, you're not going to be able to do that. So again, finishing up on this slide, a couple important more concepts would be current employer plan and Roth IRA accounts. These are examples of accounts where oftentimes the money is not able to be transferred. Definitely not with a Roth IRA, because the IRA rules do not allow one to transfer money from a Roth IRA to a 401k plan. The other example would be a current employer plan. So the rules, although the rules would allow one to transfer money from a current employer plan, what's often referred to as an in-service distribution, typically the rules that apply under that plan are not going to allow it. So your current employer is going to say you're not going to be able to transfer money out of your 401k to another 401k until you leave your job. And sometimes they'll have a waiting period of, say, a month or even longer, particularly if you're working at a smaller company and you might be invested in, say, this stock of a closely held corporation where they can't just liquidate your 401k assets quickly, you know. Okay, so let's move on to the next topic, which is who holds my 401k, my solo 401k funds. So the standard is really that the funds be held at a financial institution. So that could be a bank, you know, such as a local bank or a credit union. It could also be a brokerage. In terms of that account setup, what's going to be most important from a 401k perspective is that the account is established in the name of the plan and that it uses the EIN for the 401k. So just to use our establishment process as an example, you know, our clients will fill out our application, and then by the next day, we will email them all the establishment documents that are needed to establish the 401k plan. And that same day, we would go ahead and get an EIN from the IRS for the plan. And that's the IRS, based on guidance that we've gotten from the IRS specifically, that's their expectation for solo 401k plans. So this is going to be an EIN that's actually separate and distinct from the EIN that they might have for their self-employed business, such as their LLC or their S corporation. So this is an EIN in the name of the plan. And as part of the registering that plan with the IRS, you know, of course, we're going to indicate that it's a 401k plan, and the IRS will issue an SS4 form, or essentially looks like a letter from the IRS that has the EIN number, and that EIN letter is going to have some good language that confirms that the plan is a tax tax deferred entity, which is great. And so in establishing the account, you know, the individual is able to go to their local bank. We have contact people, for example, at financial institutions such as Wells Fargo. They can also have the account set up at a brokerage, for example, Fidelity or Schwab or TD Ameritrade. And wherever they go, what's important is that the account is in the name of the plan, the name of the solo 401k plan, and that it uses that EIN for the plan. And if you think about it, that's important, because let's say that there's, you know, some type of interest or some type of return that's earned on that account, and the financial institution is issuing a 1099. Well, they're going to issue that 1099 in the name of using the EIN for the plan. So the IRS is going to know that, hey, this is a 401k plan, so they're not going to go look for that income to be reported on anybody's taxes, right? So in terms of bank versus brokerage account, what's important to understand is that the individual, number one, can have you can actually have both types of accounts. So oftentimes we'll see individuals that, for example, are looking to invest in real estate, and we'll get into more of this in a moment, but they'll want, for purposes of their real estate investment, they'll want to have a bank account. They'll want to be able to get certified checks. They'll want, because they might be going to auctions, for example, they might want to have a debit card. So the bank will issue a debit card with respect to that account. So that's going to make it easier to pay for expenses related to their real estate investment. The advantage of the brokerage account is, of course, that you're able to still invest in traditional investments, right? If you want to invest in the stock market or a mutual fund, of course, you can't do that through a bank account. You need a brokerage account. And so the brokerage firm or the bank, they're going to act as the custodian of the account. They're not going to police it. That's going to be our responsibility. We're the 401k provider. We have the IRS approved plan. We handle all the ongoing compliance requirements with respect to the 401k plan. So if you take a distribution from your plan, the 1099-R would need to be reported to the IRS, and we would handle that. Fidelity or Wells Fargo or your bank is not going to do that. Again, they're not policing the account. They're just a custodian. And so sticking with the brokerage accounts, though, what's interesting is a number of these brokerage firms that we work with will actually issue a checkbook on the account. So the individual still has that checkbook access like they do with the bank account, but they'll also get the investment options that come with a brokerage account. They can invest in mutual funds, stocks, CDs. So it's kind of a hybrid between the bank and the brokerage account. Again, not all brokerage firms do that, but a number of them do, such as Fidelity, and Schwab, and TD Ameritrade. So sticking on this topic in terms of where the account is at and who holds my funds, thinking back to our eligibility discussion, where you had, say, the realtor, right, the husband and wife, they've got their realtor business, no W-2 employees, so they're eligible to set up a solo 401k plan. What's important is that the husband and wife's money is actually kept in separate accounts. So they could name their plan, say, Realtor Solo 401k Trust. And so husband will have an account in the name of Realtor Solo 401k Trust for his benefit, and then the spouse would have another, say, bank account in the name of the 401k for her benefit. So when the funds are rolled into the plan, her money is going to go into her account, and then his money would go into his account. And so this same concept of keeping separate accounts also applies even if you have one person, if you have pre-tax money and Roth money. So with the solo 401k, you can have a Roth account. So you can have Roth funds, provided your provider's plan allows for it. I mean, for example, our plan does. And so when you have that Roth money, it actually needs to be kept in a separate account. So even if it's just one individual, say they have the IT person that has a W-2 day job, that has the side business, right? That person might have their IT solo 401k trust account. If they've got Roth money and pre-tax money, they're going to have two accounts. One is going to be for the Roth money, and one's going to be for the pre-tax money. And just to shed a little more light on this, I mean, as part of our services, we do handle all of the documents that are needed, for example, to open the accounts at the different brokerage firms that we work with. So we would prepare all that paperwork, and then the individual, the client, just needs to sign the paperwork, and it's submitted to the brokerage firm, and then the account's typically open in just matter of a couple days. So typically, these accounts can be set up in just less than a week, and then it's just a matter of transferring the funds over from wherever they are today, whether it's back to our list of eligible accounts to transfer funds from. Okay, so let's keep going. Let's talk about investing in real estate. So if you ask me what are the top 3 reasons that people want to set up a solo 401k plan with us, it's going to be investing in alternative investments such as real estate. It's going to be the ability to make contributions, and it's going to be the loan feature. So that's what we're going to focus on now. We're going to talk about all those topics right now. So let's start out with investing in real estate. And these concepts, keep in mind, do apply to the other types of alternative investments that you can invest in. Because really, in terms of investing in, when people ask what type of investments can I invest in, it's really a two-step analysis. Number one is it allowed under the rules, right? The statutory rules that apply to 401k plans. And then is it allowed under the plan itself? So it's got to be allowed under both. So even though the rules do allow for investing in real estate, typically a 401k plan, most 401k plans that people have experience with are not going to allow for that type of investment. Because you might have a big, your corporate plan where you're just able to invest in, say, an aggressive mutual fund or a conservative mutual fund, or even if you have a solo 401k through another company such as Fidelity or Schwab, they offer solo 401ks, but their plans are going to limit you to investing in something where they make money, because that's how they make their money. Is they'll allow you to set up a 401k, but they want to capture that deposit because the investment options under their plan is just going to be, could be a mutual fund that they offer, or it could be equities where you're going to be incurring trading fees. And so with our plan essentially tracks what's allowed under the law. And so if you can invest in it under the law, you can invest in it under our plan. So clearly real estate is allowed under our plan. And so since that's one of the top reasons that people want to set up a solo 401k, I definitely wanted to spend some time talking about some key concepts when it comes to investing in real estate. So the answer is yes, you can. In terms of those key concepts, one very important concept is that in terms of the titling of the investment, it's going to be very important that it's done in the name of the 401k plan, or the name that you would choose as part of the establishment process. So that real estate title it's got to be in the name of the solo 401k. The income and expenses related to that investment. Let's say it's a rental property, right? So as that rental stream comes in, or as you incur expenses, all of that money is going to come in and out of that 401k account, right? So your renters are writing checks to your 401k, you're depositing it in your 401k bank account, and then when it comes time to fix the toilet or pay for some other type of expense related to that investment, you're going to be paying for it out of that account. So thinking back to our discussion of where the money's at, you may recall I mentioned that a lot of people like to have a bank account, right? So that a lot of that goes back to just the simple administrative ease of having a debit card, right? Because that's going to just make it easier to pay for those expenses. Going on to the next bullet here, no personal use. So, let's say it's an Airbnb place, right? It's a rental property that you're marketing, you own through your 401k, and you're marketing on Airbnb, and you're not able to rent it out one weekend. You're not going to be able to use that or have your family members who are in town visiting you use that property, right? No personal use. It's a vacation home, right? You're not going to be able to go and use it for 1 week, even if it's just 1 week, even if you pay your 401k. You cannot do any of that. All that is going to be clearly prohibited under the rules. Another type of restriction is no, quote, sweat equity. So what I mean by that is, let's say you're a type of person that likes to, fix up a house. Even though you have that skill set, even though you're saving your 401k money, you're not able to work on the property. So if the toilet breaks, you're going to have to call someone, a contractor, to come and fix it. So let's, moving on, let's talk about another common scenario. Let's talk about spouses. So again, let's think about that realtor couple, right? That is self-employed, no employees. They set up a solo 401k. The husband has his account, the wife has her account. They're both in the name of the 401k for his and her benefit. They roll over money, say from an IRA, and they're in the real estate industry, so they know the market. They invest in a rental property, right? When it comes time to invest in that property, if they both want to use their funds, they certainly can. What's going to be important, though, is that the income and expenses related to that investment need to be allocated based on the amount of money that they invested. So if the wife invested 60% and the husband invested 40%, she's going to be entitled to 60% of that income, but she's going to be responsible for 60% of the expenses. So when it comes time to buy the property, they're going to write 2 checks, right? So the money comes from each of their respective accounts. Going forward, though, for administrative ease, they could have the money coming in and out of one account. They would want to reconcile, though. They would want to reconcile at least on a yearly basis, and certainly before they took any type of distribution from the plan. So let's stick on real estate, because there are some other good topics that we can go over that often come up. Another would be tenants in common. So this is going to be similar to the spouse scenario, but there's some key differences. So tenants in common refers to the fact that you have 2 owners, essentially. So you might have a scenario where someone says, well, I have, say I've kind of spent some money, maybe an inheritance, whatever it might be. They've got, if it's not qualified funds, right, it's say $50,000 in there that they want to invest in real estate. And let's say they have $50,000 in their 401k, right? So that individual might want to go out and buy a property. I guess it'd be obviously a pretty cheap property for $100,000, but let's just to go with it. So in that situation, the individual and the 401k are going to be the owners of the property, and they're going to own it as tenants in common. So similar to the spouse concept, where the funds come from both accounts, and the income and expenses are split in accordance with the ownership percentages. So in that situation, it's 50-50, right? A difference, though, with the spouse situation is that you wouldn't have, let's say it's a rental property. You wouldn't have your renters writing checks just to the 401k. They'd actually need to send money to both the individual person, and the 401k. So you couldn't have the money coming into one account like we talked about, where you have 2 spouses that have a solo 401k. So that's going to be an important difference. But that is a way where one is able to couple money that's in their 401k account along with funds that are in their personal account. So that can be a pretty powerful tool. Sticking on real estate, the final concept is non-recourse financing. So what we mean by this is that you're actually able to use funds that are in your 401k to buy real estate along with debt, but it's got to be a special kind of debt. It's got to be what's referred to as non-recourse financing. So most banks, they're only going to do conventional financing. So that means that, for example, take your house, right? You own your house, and if you don't pay your mortgage, the bank is going to foreclose on the property. They're going to sell it quickly. It's going to sell cheaply. They're going to take that money and apply it to the balance of your loan, right? And then they're going to turn around and sue you for the outstanding balance, whatever's left that you owe the bank, because the bank has recourse against you personally. That's conventional financing in a nutshell. Non-recourse financing is different, because the bank is not going to have recourse against the owner. So in this case, if it's the 401k, right, the bank is not going to be able to go after your 401k. And so that means that they're going to view this differently from an underwriting perspective. You're going to see higher down payment requirements. It could be 30, 40%. You're really looking at specialty finance companies out there that do this. Another difference is the terms could be shorter. The interest rates are going to be higher. But there are ways to combine your 401k funds with debt. And again, that can be a powerful tool. Okay, so let's go on. So again, back to the list of common reasons, the top 3 reasons. Another is going to be taking a solo 401k loan. So again, think about the realtor couple again. They may have been self-employed, their entire life. They may not have a 401k. They may have accumulated funds in an IRA, right? and you're not able to borrow from an IRA. The IRA rules don't allow you to take a loan. So they may want to even use that money to grow their business. They might want to do some type of marketing campaign. So if they're eligible to set up a solo 401k, they've got eligible type of retirement money, they can transfer it over, say from their traditional IRA into their 401k, and they're able to borrow from that 401k. And there isn't any type of approval process. It can be in a matter of a day. If the money's in their account, then they can just take that loan. They're able to take up to 50% of the balance, not to exceed $50,000. So if they transfer over 100,000, they can take out 50. If they transfer over 50, they can take 25. If they transfer over 200, they can take out 50. Because again, it cannot exceed 50,000. In terms of the terms, the loan is going to be payable either monthly or quarterly. It's up to the client. It's going to be payable with payments of principal and interest. And the interest rate has got to be a reasonable rate. Based on guidance from the Department of Labor, it would be prime plus 1%. So that's definitely where the vast majority are at. There is some flexibility. For example, you can look to CD rates as another resource to build the rate. But it's typically going to be that prime plus 1%. So currently that's going to be 4.5%. Of course, you are not paying it to us. You're not paying it to Fidelity or whoever's holding the account. You're paying it to yourself, right? You're paying it back to your 401k. Those payments are going to be spread out over a 5-year term, unless you're using the money to purchase your personal residence, in which case you can have a longer term, but it's typically going to be 5 years. There's really no restriction on what you can use those proceeds for. You could pay down a credit card debt. You could use it for business financing if grow your self-employed business. You could use it for your kids' tuition. I mean, there's all kinds of uses. You're really not limited in what you can use it for. It's going to be important that the loan is documented. That's because it's going to look like a distribution, right? You're taking money out of your 401k, so it actually falls within an exception for a participant loan. In order to meet that exception, though, you've got to have these different terms that we just went over, and the loan itself needs to be documented. So as part of our services, we handled that loan documentation requirement, and we do that for no additional charge. We do it within 1 business day once the client notifies us they want to take a loan. So it's very fast and easy. You can pay off the loan with no prepayment penalty. In terms of some of the little bit of the complexities in terms of loans, one is going to be multiple loans here at the bottom of the slide. Another is spouses. So in terms of spouses, a common question that comes up is, well, the $50,000 limit, does that apply across the whole plan, or is it just to my account? And the answer is it's at the participant level. So if you have the realtor couple again, they're both able to take a $50,000 loan if they each have at least $100,000 in their account. Now, in terms of multiple loans, the key concept here is, a common question that comes up is someone might say, well, I want to take a $50,000 loan. I'm going to use it for this investment. I think I'm going to get paid back in 6 months. So I want to then just pay off the loan, and then I'll probably take another one a month later. And so the answer is you cannot do that, because there's a 12-month look-back period in determining the balance or the maximum amount you can take over of the loan. So if you've got a $50,000 loan, the outstanding balance on your loan in the previous 12 months, even if you pay back that loan, you're not going to be able to then just take another $50,000 out. So the actual calculation is a little bit complex, but essentially that's the key takeaway for purposes of today's discussion. Obviously, with our clients, we work through that calculation and determine exactly what they're able to take out. Okay, so let's go on to that last slide here for today's session. How much can I contribute to a solo 401k? Again, one of the top reasons that people will contact us about setting up a solo 401k. The answer is a lot more than you could contribute to, say, an IRA, or even if you have a W-2 employer-sponsored plan. Because what's interesting with the solo 401k is that there's actually 2 types of contributions that you can make. In the words of the IRS, if you look at their guidance, they actually talk about how you wear two hats, right? You're both the employer and the employee. So you can make both employee as well as employer contributions, right? Now, in terms of determining the limits, there's several factors. Like I talked about before, one at the beginning in terms of eligibility, you've got how the business is organized and taxed. That's a factor. Age is a factor. The income, the self-employment income that the individual makes is going to be a factor, as well as whether or not the individual is participating in another 401k plan. So we have a calculator on our website. We have a lot of great information. We work with our clients, of course, to figure out what they're able to contribute. But just to kind of take some simple examples to illustrate these contribution limits. Let's say you've got an S corporation. That's your business is organized as an S corporation. So one factor again is how much you make. So you cannot contribute more than your self-employment income. If it's an S corporation, that's a function of the W-2 wages. So let's say you have an S corporation where you have $50,000 of W-2 income. You're self-employed, it's just you, right? No W-2 employees. Let's say one situation is you're under 50, right? So in that situation, you're going to be able to contribute up to $18,000 of your W-2 income as an employee contribution. If you're 50 or older, you can make what's called a catch-up contribution. So that would be an additional $6,000. So that takes you up to 24. So that's the employee limit. It's going to be 18 or 24. The next contribution type is employer. So sticking with that same individual that has $50,000 of W-2 income from his S corporation. He's able to make a 25% contribution as a profit-sharing contribution or employer contribution. So at $50,000, that's going to be $12,500. So if the individual is under 50, he's able to make up to $30,500 or an additional $6,000 if he's 50 or older. Now the overall limit is going to be $53,000. So even if the individual is making, say, $200,000, they're not going to be able to put in more than $53,000 or $59,000 if they're 50 or older. And that's the 2016 limits. They could go up. Oftentimes they do, for cost of living, and we'll know more at the end of the year whether the limits will be raised for 2016. But that's the 2016 limit. So now let's add some complexities, right? Let's say that the individual let's go back to that individual that's the IT professional, right? That has the W-2 job and that has their side business, that's the web design company, right? Let's say that individual is maxing out at their W-2 job. They're trying to get all the match they can get from their W-2 employer. So they're putting $18,000 into their W-2 employer sponsored plan. So the employee limit is at the employee level. So the limit is going to look at all the plans that they're participating in. And since they're maxed out under their employer sponsored plan, they're not going to be able to put any more into their 401k, their solo 401k. So if that person is an S corp making $50,000 of W-2 wages, they would still be able to make the employer contribution, the profit sharing contribution. Because the employer limit is at the employer level. So it's not going to matter whether they have another plan that they're participating in making contributions to. So that's a key concept. In terms of other types of, just to stick on how it varies, again, so we've started to learn a little bit about how it varies. One is age, so you're able to make the catch up if you're 50 or older. Another variance is going to be whether you're participating in another plan. So you can see that if you're participating in another plan, that's going to count towards the employee limit, but not the employer. Another factor, again, is how the business is organized. So if it's an S corporation, it looks at W-2 wages. That's going to be the determining number. If it's a sole proprietorship where you're reporting that income, or a single member LLC where you're reporting that income on Schedule C, then the determining number is going to be a little bit of a calculation. You take line 31 off of Schedule C, and you reduce that by 1/2 of the self-employment tax, and that would be the driving number. If you went through that calculation and that was 50,000, say for a sole proprietorship, you would still be $18,000 of that, or 24 in terms of the employer limit. In terms of the profit sharing limit, though, it's not going to be 25%, it's going to be 20%. So it's going to be a little bit different. And again, we've got a calculator, and of course we work with our clients to determine those limits. So it can be a little complex, but that would be another factor. In terms of different types of contributions, continuing on in the slide here, you've got Roth contributions and after-tax contributions. So this is definitely some higher level concepts here. So just to touch on it a little bit, Roth contributions, those are going to be part of your employee contribution. That's an employee contribution, just like a Roth IRA. It's after tax, so you've already paid tax on the money, you're putting it in. If you satisfy the qualified distribution requirements, such as keeping the account for at least 5 years, waiting until you're 59 and a half, then you're going to be able to take that money out tax-free, including the gains. So that's going to count again towards your employee limit. So just to illustrate that a little bit, sticking with that sole proprietor that is the S corp that puts in $18,000 as an employee contribution, that person would put that into a separate account, because remember we talked about how with a Roth account it needs to be a separate bank account or brokerage account, and they could put that $18,000 into that Roth account. After tax, that's another higher level concept, not as widely known. If your plan allows for it, you can actually make after-tax contributions even above and beyond the Roth limits, provided your plan allows for it. That the after-tax limit is going to be subject to the overall limit, which again is the 53 or the 59. So it's not going to be subject to that 18,000 like you have with the Roth. It actually goes into another separate account. So a number of our clients actually they could have 3 separate accounts. They could have a pre-tax account, a Roth account, and then the after-tax account. So that's another concept, and we can talk about that offline with you individually if that's something that you want to look at. Self-employment income, like we talked about, even though the overall limit's 53, if you only make $20,000, you're not going to be able to put more than $20,000 into your 401k plan. Spouses, we talked about that, we talked about that a lot, in terms of separate accounts, separate loan. So it's going to be separate contribution limits. So if it's that S corporation, right, it's going to be based off of that spouse's W-2 income. You're not able to double dip off of one person's W-2 income in determining the contribution limits. And finally, we touched on contributing to multiple 401k plans. That's, again, the concept with the individual that has the day job that they're contributing to, and then they're also contributing to the solo 401k. So that goes through all the contribution topics that we wanted to go over today. And that really brings us to the end of the presentation. I do appreciate everyone for joining. We'll go ahead and send around a recording of this presentation. And please don't hesitate to contact us. You can reach us at 1-800-489-7571. You can email us at info@mysolo401k.net, or you can email me directly at george@mysolo401k.net.